Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I'd like to talk about what does great look like from a mortgage broking perspective. So what does a great mortgage broker look like? What are the core competencies? When I started Pro Solution back in 2002, so a long time ago now, I left a career in corporate finance at Deloitte because I saw that the mortgage broking industry was in its infancy and I thought it could really have a big impact. And I thought it was a great opportunity to get into a new industry. Because at the beginning, back in 2002, that's how we started as a mortgage broking firm. And I believed that mortgage brokers had an opportunity to add a lot of value. And in fact, around 2010, 2012, sort of around that time period, I wrote a manifesto for the mortgage broking industry, published on a website, mortgagebrokerrevolution.com.au. Not there anymore, by the way. It's, that's 10 plus years ago. Anyway, the manifesto outlined why I believe the mortgage broking industry would eventually exceed 50% market share. That is, that 50% of Australians would go to a mortgage broker for a new loan. And at the time, the market share was, I think, high 30s. And I also then created an online training course for mortgage brokers, spoke at various conferences and those sorts of things. So around about that time, I put a lot of effort back into the industry. Look, fast forward to today, the mortgage broking market's market share is 75%. So I'm not going to claim any credit, obviously, for that growth. But what I outlined in that manifesto, I think, has really come to fruition. And so my thesis back in 2010 was that mortgage brokers kind of are the first point of contact for professional services for most Australians. And if you think about it, I mean, particularly first home buyers, for example, that's the first time they're going to need a financial service. And really good mortgage brokers typically have a strong network of trusted professionals. And so my thesis was by building a really strong, trustworthy, honest relationship with clients, they're actually then in quite a unique position to sort of guide them in the right direction and steer them away from making, bad mistakes like buying a dud property or, trusting the wrong person. They can steer them to a really good accountant, a reputable buyer's agent, a financial planner if they need them. And they're sort of the gatekeeper to the financial services industry, if you like. And that's why I believed and still believe today that they occupy a really tremendous position to help Australians significantly. It's not just about writing a loan. It's really about building a relationship and helping them on their way. And most bank staff can't compete with that, right? So most bank staff, wouldn't know an investment grade property if it hit them on the head and wouldn't have those sorts of networks. Of course, most mortgage brokers, are property investors themselves, they're share investors, they're sort of already doing what they're sort of talking to their clients about. Now, of course, like any industry, the top 20% in most industries are far ahead of the average, and that's true with mortgage broking as well. On the other hand, the bottom 50% probably of most industries, again, should be avoided entirely. And that's certainly true for mortgage brokers. Look, I think thankfully that the caliber of people joining the broking industry today has significantly improved compared to 20 plus years ago. 20 plus years ago, I remember going to conferences and so forth. The caliber of individual joining the industry at that stage was highly questionable. But of course, also in any sort of commission-based industry, there's always going to be some bad apples, some people doing the wrong thing, some people really focused on driving short-term profit rather than trying to create long-term value for clients. So I'm not saying every mortgage broker is fantastic. I'm certainly saying the top 20% of the industry are probably likely to be fantastic. And that's really where you need to, aim your attention. And so I sat down and thought about, what are the 5 things that I think mortgage brokers, should be doing or do or have that sets them apart, that makes them a great broker and a broker that's, positioned to really add value to your position. And in this podcast, as you know, anyone that's been listening for some period of time, I never talk about my business Pro Solution. I never try and sort of put the hard sell on or anything like that. My view is with these things, look, if we put some really good information out there and if it resonates with you and when the time is right, you'll probably reach out, for some assistance and whatever. So I don't feel like I really need to sell, and I'd rather this podcast really be my opportunity, and Campbell and hopefully some of the other team members as well, to share our insights with you. Anyway, however, during this podcast, I am actually going to reference my business a little bit, just to sort of give you an example of the point that I'm sort of talking about. And of course, these 5 things, I believe them personally very strongly. I believe them from an industry perspective and from my business perspective. So of course, these 5 things are going to be reflected in my business. That's natural. But I just wanted to put it out there because I don't want to come across like a sales spiel. All I'm trying to do is bring home the point. And as I said, the top 20%, most of those brokers are probably going to possess at least most, or if not all 5 of these attributes. And there's a lot of great brokers out there. Okay, so let's start with number 1. And obviously, if you're seeing a mortgage broker because you own property or you hope to own property. So my number 1 thing is investment property experience is essential. So it's probably no surprise that I tend to spend a lot of time thinking deeply about my own financial situation, and have been doing so for way more than the past 2 decades. And so quite often, particularly for, topics or episodes in this podcast, quite often they're a result of me thinking about my own personal situation, whether it's how I'm structuring my will, or I'm going through a refinance at the moment, and I've something sort of gleaned on me. Though a lot of topics come from that. And of course, a lot of topics also come from talking to clients and working with clients as well. But the point is that you tend to think quite deeply about your own personal situation. And so if you're seeing a lawyer, for example, that's been through a separation, a family lawyer that's been through a separation, they're probably going to have a better understanding, insight, because they've experienced that terrible situation. Quite often it's a terrible situation themselves personally. And, I think that holds a lot of weight. So, with over the last 20 years, either personally or professionally, chances are I've encountered most challenges, most problems, wide-ranging scenarios, mistakes, successes, all these sorts of things. I'm not saying I know it all. I'm sure there's plenty of things I haven't seen, but really I've seen a lot. And, that level of experience, I think, is really invaluable. And that's why I think it's important to work with a firm where the broker that you're dealing with either has deep experience in property investing, or the leader of that business has deep experience in property investing. Because that way they will design their processes and their training and really everything they do around trying to maximize value. And I think this is true even if you're dealing with a first home buyer, right? Or an own occupier or something like that. Let's say you don't even need any property investment advice. With a first home buyer, we would talk to them about, well, it's probably not going to be your forever home. Maybe you'd like to keep it as an investment down the track. So why don't we consider that when we're selecting the type of asset? Or if it's a home and there's sort of compromises with the property that the client's making, we can talk to them about it. We can say, look, properties on a main road don't tend to perform well. If you go and resell it, you might run into some troubles there. Just think about that before you buy it. So again, this sort of property experience, I think, has wide-ranging impact. And really, the ultimate reason you seek professional advice is to avoid costly mistakes. And a good broker is going to help you avoid costly mistakes. A bad broker is just going to focus on the loan and just go, okay, you need a loan, here's your loan, off you go. A really good broker is looking for reasons to add value, partly because they know that if they do so, you'll be probably a loyal client for a long period of time. But I also think the right people, they're mostly doing it for their own satisfaction as well. They like to help people, they like to share their knowledge, and they like to see their clients be successful. And that gives them a lot of satisfaction, probably one of the key reasons why they do it. So property investment experience is essential. Let me turn it around, because I've heard some horror stories about, the advice that the bankers give clients. So that is, people sitting in a branch that work for a bank, and their advice, some of the way they structure loans or the advice they've given people, clearly they have no idea about property investing. And that's really when you're going to kind of run into trouble. Okay, my second thing is about tax knowledge and experience. So really, interest for investors is probably their largest tax deductible expense. So, of course, it's critical that you don't jeopardize that valuable tax deduction because, that's really what's going to help you defray the cost of holding the property. The thing is that tax planning, when you need some tax planning or advice, might always not be obvious to you, at least not in the outset. So, again, if I use the first home buyer example, again, they might not even be thinking about tax deductions or whatever. They just want to buy a home that they want to occupy. But again, if it ends up being an investment property one day, then we might want to think about how we're structuring the loan, how we're structuring loan repayments, use of offset account, those sorts of things. And again, getting that advice off someone that doesn't really think that far ahead and doesn't know about the difference in the tax treatments. Again, you miss that opportunity. It's only when, down the track 10 years from now, they decide to convert it into investment property that they realize they should have made a different decision 10 years ago. But of course, it's too late by that stage. Now, to be clear, of course, mortgage brokers are not tax advisors. So I'm not suggesting you ask your mortgage broker for tax advice. Only a registered tax agent with the Tax Practitioners Board can give you taxation advice. Of course, our firm is a registered tax agent, so am I personally, but that's not important, right? What I'm saying is brokers should have a strong understanding. They're not providing tax advice, but it allows them to understand the tax advice if you've been given it and implement their loan structure accordingly and correctly so that it's going to fulfill that tax advice. Similarly, they need to have enough knowledge to understand what's wrong and what's right and then steer you in the right direction. But ultimately, if you've got a tax question, you want some tax advice, make sure you're getting that advice from a registered tax agent and no other people. I mean, there's lots of well-meaning people out there, but they might not fully understand the intricacies of the tax legislation. And so you need an experienced professional for that. And, this is one of the benefits, I guess, our team members enjoy. I mean, they work side by side with accountants and they're obviously often collaborating on the same clients. So, our mortgage brokers get to learn a lot about taxation and the tax rules and how that affects loan structures. But similarly, the accountants in our team also then learn about loan products, structuring, credit policy, all these sorts of things, because that's the other side of the coin too. If you've got an accountant that doesn't really understand, mortgages and loan structure and all those sorts of things that I just mentioned, that can be a problem too because they don't really understand what's possible and how to structure something so that it's going to do what it needs to do. So I guess you could flip it on the other side and say, look, accountants need to have a little bit of mortgage experience and knowledge as well, but a holistic team, really helps from that regard. So dealing with a broker that doesn't understand tax is a real problem. You could end up making a mistake that might not be obvious today, but might be obvious down the track. Okay, the third attribute is that they should have a solution-focused mindset. So back in 2009, I wrote a book called The Property Puzzle. And the idea behind that title was that building a property portfolio is a little bit like solving a puzzle. All the pieces need to fit together in the right way to work. And in fact, as a bit of a sidebar, I really disliked that book. In fact, I threw out all the copies that were in the office a few years ago. I just didn't want to, I don't think you can buy it anymore anyway. Anyway, it's neither here nor there. Quite often when I actually look back at anything I've written sort of 10 plus years ago, I think, gee, that's terrible. Anyway, whatever. I guess we're all our own harshest critics. But anyway, the whole point around the property puzzle, mortgage broking is a little bit like that as well most of the time. It's really, we're presented with a client sort of scenario, their income, expenses, assets, liabilities, and then they've got a goal like, building an investment property portfolio, upgrading the home, whatever it is. It's our job then to solve that puzzle by finding, that what's in the client's best interest and then matching them with the right lender so that it aligns with their situation. It's like putting that puzzle together. So firstly, you've got to solve the puzzles. What should they do? What's safe? What's appropriate? And then finding the lender that's going to fulfill that. Now, of course, there's some applications that are really simple and straightforward and really smooth and easy. Unfortunately, there's not a lot of them. There's also going to be scenarios that are super complex, and that's where that problem-solving mindset needs to sort of kick in. Quite often, we've got a lot of experience, obviously. I started the business in 2002, so a lot of mortgage broking experience. You can often really work out is this a deal? Is this not a deal? If you think it's a deal, then you've really got to keep working and working and working until you find a lender that understands what you understand. It's really about pitching the application in the light that you see it. Why do you think it's a deal? Why do you think it's low risk? And positioning and communicating that effectively. And then finding the right lender and then the right person within that lender. That's critical, right? You might say, oh, NAB's terrible as a general rule, but there'll be a couple of bankers in NAB that are really great at what they do. So it's really about the lender and then the person you're dealing with within that bank. And the other part to that is that if you've then built a really strong relationship with that lender, like we have with many of our banks, we've had a mortgage book there for, coming on 23 years, and there's no arrears, there's no defaults. We've got a really strong track record. That adds weight to the application as well, that it's coming from a known broker that has a strong track record. That credibility can significantly strengthen applications. But it's important to work with a broker that has this sort of client for life mindset, that's not about just writing a loan today, settling a loan and then sort of moving on to the next file or whatever it is. It's really about investing as much time as possible to build a long-term relationship. And there's some situations, really complex deals, where we've had to spend several months to get to the end. But that sort of solution mindset is really important, that tenacity to keep going and making sure we're going to hit on the client's goals and help them achieve what they're looking to achieve, I think is really important. Whereas there's a bunch of mortgage brokers out there, they're very transactional. They want the easy stuff as possible, and they're not necessarily the ones that you want to deal with, particularly if the goal's, to build a long-term relationship with one individual. You want that individual to really dig in when it's really necessary. Okay, the fourth attribute is they have a lot of clients just like you. So in mortgage broking, it's difficult, and probably like most industries, difficult to be a jack of all trades, managing a wide variety of different clients and different products. So that is, if I want to go and deal with first home buyers, low doc loans, self-employed clients, commercial loans, if I want to do it all, it's not impossible, but it is challenging, because like anything, if you do it all the time, you really get good at it and you don't make the mistakes, or as many mistakes as someone that doesn't have as much experience, of course. And that's why you find that most successful brokers often find themselves a bit of a niche. And that specialization helps them gain deep experience in either a particular industry, a particular type of client, a particular type of product, and then build strong relationships with the lenders or specific bankers that really cater specifically to that niche. So therefore, it's good to deal with a broker that looks after clients, a lot of clients that are in a similar position for you. So for instance, our specialization for many decades has been working with high income clients, including self-employed people, but sole traders, PAYG employees, those sorts of things. So barristers, professional services, medicos, these types of people. And so over time, we've built really strong relationships with key banks that provide unique products or credit policy, things like longer loan terms to boost borrowing capacity, mortgage insurance waivers, access to the private banks part, the private banking part of the main banks for, more one-on-one sort of service, these sorts of things. So, if we come across a client and they represent that, they're sort of high income earning clients, we've got a good suite of products to really help them effectively. But the point is, find that broker that has that large client base of people just like you, and you'll find that they're often going to be really easy to deal with, and they're going to have explored, most of the solutions that are possible that might suit your situation. Okay, and the fifth and final attribute I think a great broker has is they're willing to tell you what you don't want to hear. So we'll never help a client do something if we don't think it's in their best interest. So, for example, if we think they've got enough borrowings and they're borrowing more, we'll put them in a really risky position. We'll tell them that. We'll say, look, we can't help you. We don't want to help you, get into trouble. That's obviously silly. We want to, obviously, building wealth is a marathon, not a race, and you need to manage that risk. If we've got a client that, is buying a really dud property and we think it's and it's a pure investment, of course, not a home, and we think it's a terrible property, we'll outline all the reasons why we think it's a terrible property and tell them you should not buy this property, you should get out of that. And even though we've got, it goes against our commercial interest, I guess, because, if the client doesn't do what they want to do as brokers, we don't get that business. But, I'm proud to say in 23 years, we've not had one client default or get into trouble with their loans. And, I think mortgages are a fantastic servant, but a terrible master. And so sometimes you've got to push the boundaries, and sometimes it's entirely appropriate to do that. And sometimes, in fact, we have to counsel clients to, be a little bit more aggressive and give them a bit of a nudge to sort of push themselves further. So that's entirely possible too. Other times we've got to cool their jets a little bit and say, it's too much. Just just sort of put it on ice for a little bit of time, just wait for your situation to improve and then maybe consider borrowing in a few years' time. Point is, we don't really care about our business or what it means to our business. It's really about putting that client first and making sure their best interest is the number one thing that the broker's going to really think about. And that's, I think, a really important key attribute that a great broker has. That despite the fact that they're only paid when they write a new loan, if they tell you, do not do this, do not borrow more, do not buy this property, I think that's a really good hallmark of a great broker that's not afraid to tell you something that you probably don't want to hear. Okay, so let's recap those 5 things. Property experience is essential. They need to have good tax knowledge. You're not getting tax advice from them, but they need to understand how tax applies to loans and loan structuring. They need to have a solution-focused mindset and the tenacity to really follow through on doing whatever they need to do to help you. They need to have clients that are like you. So if they've got a niche, you want to be in that niche. And fifth, they're willing to tell you something that you don't necessarily want to hear. Now, many people think that the defining trait of a great broker is simply getting you the lowest interest rate loan. But you notice, though, that I haven't mentioned interest rates and fees in those 5 things. I think getting the lowest interest rate and getting the best deal is an obvious outcome of working with a broker. I think that's just your ticket to the dance, if you like. Of course, you've got to do that. And if all you need is the lowest interest rate loan, then I'd say there's countless websites that will help you identify the lender that has the absolute lowest interest rate. But I think a great mortgage broker can help you a lot more than just finding the lowest interest rate loan. A great broker's real contribution is helping you achieve your goals, making really smart moves, avoiding making mistakes, and steering you in the right direction in terms of the right professionals to you and kind of leveraging their network. I think that's the key value that a broker can provide. And a broker that has these 5 attributes will allow you to do that. Okay, I hope you found that useful. I hope that really helps you. I guess you can think about of the brokers that you've dealt with, if you have dealt with them in the past, how do they stack up to those 5 things? And if they don't stack up, well, hopefully that gives you a little bit of a metrics or a way of sort of working out or finding a great broker. Obviously, referrals are a great way to find any good, trustworthy professional, and particularly if you get a referral from someone that sort of traveled the road that you want to travel. So if it's building a property portfolio, try and find someone that's already done that and work out, who they've used. It's not always a magic bullet, of course. I think it's still worthwhile to think about these 5 attributes, but just to narrow down the potential brokers that you might want to deal with, I think a referral is a great way to do that. And the same is true for most financial professionals. I think referrals is a great starting point. All right, let's get into some listener questions. Okay, first one is from Marcus. Marcus writes, what a wonderful podcast. My number 1 financial listen to. Well done. Thanks a lot, Marcus. A question regarding super if you have time. I'm a 52-year-old professional, currently with Uni Super in high growth. Balance is circa 900,000, maximising concessional contributions and recently started maximising non-concessional contributions, likely to retire around 65, so 13 years' time. I understand capital gains is captured in the unit price with industry funds, thanks to your previous podcasts, and thus realise at pension phase. Would you imagine that people in my circumstance, it makes sense to transition to a wrap platform to avoid this at a relatively late stage of my super journey? recognizing that simplicity is a valuable aspect of my investment journey. Again, thanks for a great podcast. So, Marcus, you've got 900,000. You're making pretty considerable contributions to super, at least $30,000 since you're maximizing the concessional cap. And you said you're maximizing non-concessional cap, which is 120,000. So you're potentially contributing somewhere between $30,000 and $150,000. And as I read the question, you're likely to do that for another 13 years, and you've got a $900,000 starting balance. Look, avoiding the unrealized capital gains when you transition into retirement in 13 years' time, how valuable will that be? In isolation, you would go, that's really valuable. But when making a comparison, you've then got to compare, what are the returns you're going to get versus, UniSuper versus a wrap platform. What are the fees that you're going to pay UniSuper versus the wrap platform? So you can't just go in isolation, go to the wrap platform, because there's many ways of putting that wrap platform together and investing those monies. But holding everything else equal, if you're saying that the fees are going to be broadly similar, which I think they would be, I don't think there's going to be a huge difference in fees. Maybe the wrap platform, in fact, will be cheaper long term, but let's just go, it's probably not going to be that material. Then it's really just about returns. So how are you going to use that wrap platform and achieve the same returns that UniSuper is going to give you? That's the key element here. If you're confident you can do that, or you can work with an advisor that can do that, then there could be tremendous value in avoiding any capital gains when you transition into retirement or convert into retirement, particularly on your balance, and particularly because you're contributing so much. So they're the key elements there just for people that are listening. Because if Marcus said, oh, look, my balance is 100,000, I'm contributing $10,000 a year, I would probably say, look, keep it simple, stay at UniSuper. Sure, there might be a saving to avoid the CGT, but in dollar terms, it's not going to be a lot. And to try and find a way to avoid that is probably going to cost you more than the benefit that you'll get. But in his situation, in Marcus' situation, it's because the starting balance is so high and because he's making so many contributions, the potential unrealized gains that he could accumulate over the next 13 years could be considerable. So yes, is my answer, Marcus. I would imagine people in your circumstances, it would be good to think about changing the super ownership structure so that you don't have to pay any capital gains tax. Okay, next question is from Rekha. Rekha writes, great to finally reach out after being a loyal listener for so long. Your podcast is absolutely fantastic, and I hope you continue to excel in your work. Thanks so much, Rekha. She writes, I currently have investments in US and Australian shares as well as ETFs, totaling around $20,000 spread across 2 different platforms. I participate in DRP, Dividend Reinvestment Program, and in my tax return, I include all my DRP earnings in my taxable income, which is correct. However, I recently discovered an outstanding PRYG instalment of $338 owed to the ATO. According to their records, this is based on a notional tax amount of $917 from my 2024 tax assessment. I've yet to pay this amount. I'm completely clueless about this unexpected charge. I'm unsure why I owe this money to the ATO. Any general advice or suggestions you could provide would be greatly appreciated. Okay, Rekha, what the ATO does is when you lodge your tax return, they have a think about what they might expect for the 2025 year. So when you lodge your 2024 tax return, that's what they're going to think about. And if they think that you're going to be in a tax payable situation, they want you to pay that tax up front. So let me give you an example. If I have a PAYG job, obviously they take out tax every time. They pay me every fortnight, whatever it is. But if I then go and lodge my tax return and I've got no other tax deductions, the return should be about even. I'm not going to be in a big tax payable position, nor will I get a big refund because I've been paying the tax that I owe throughout the year through my salary. However, if I have other investment income, let's say I've got another $30,000 of investment income, well, I don't pay any tax on that until I lodge my tax return. So if I lodge my tax return for 2024 and say, okay, I've got this PAYG income, that's okay, that's already been taxed at the required rate, but I also had this other $30,000 of investment income, the ATO goes, no worries, okay, you owe us the tax on the $30,000. Then the ATO thinks, okay, but then you're going to have another $30,000 potentially in 2025. And then they say, well, we're going to estimate then how much tax you'll owe us in 2025, and we'll get you to pay that in quarterly installments. So they're called PAYG installments, and they're done every quarter, due on the 28th day of the following, the end of the quarter. So the March installment will be due on the 28th of April. If you use a tax agent, you've got 2 months to pay it. So 28th of May. And it's just a way of the ATO getting their tax before you actually end up lodging your tax return. Now, when you lodge your tax return in 25, because you've already paid those PAYG installments, you won't have any tax payable, or at least you'll get a credit for all the installments you've paid. And if you've overpaid, so your investment income was less than 30,000, if I'm using my example, well, of course, you'll get a refund. If it was slightly more than 30,000, well, you might have a small payable. Now, the thing is, you can vary your PAYG installments. So if I had $30,000 in 24, but I don't expect I sold those investments or put it into cash or offset account, whatever it might be. And if I don't expect to have that income again in 2025, I can contact the ATO and say, look, I'm not going to have that income. I want to vary my PAYG installments down. And of course, you can vary them up if you want to as well. But it's just a way of, a little bit like a salary, a way of the ATO, thinking about the tax that you owe in the following year. Now, here's the kicker that people need to really think about in terms of tax planning. If you use a tax agent, you have a longer period of time, or you've got a later due date for your tax return. So if we talk about the 30 June 2024 financial year, so last financial year, for a lot of people, their due date is either going to be in March or May. It just depends on their situation and structure and so forth. But let's talk about the May lodgements. So if you use a tax agent and your 24 return is due in May, what will happen is that'll alert the ATO to what your taxable income might be for the 25 financial year. So let's say that my 23 taxable income was 100,000 and my 24 taxable income is, let's say, 500,000, right? Let's say it's all investment income. I know it's a silly example, but I just want to make the point. I think, okay, my income's 500,000 in 24. I want to lodge my tax return as late as possible because I don't want to have to pay the tax, any sooner than I need to. So in May, I'll lodge my tax return that says I've got a $500,000 income in May, and then I'll have to pay my tax at that point in time. The ATO will then send me a PAYG installment for the June quarter, knowing that if my taxable income was 500,000 in the 24 financial year, then they're going to assume it's going to be 500,000 in 25 financial year, and I'll have to pay an installment on that. And because it's for the June quarter, so the last quarter of the financial year, I'll have to pay the full year's installment in that one go. So in that situation, I'll have to pay my income tax for 24 in May, and then I'll have to pay my income tax for 25 2 months after the end of the financial year. So that's the end of August. So I've got to have to pay 2 years of tax in a relatively short period of time. And that's something that people need to talk to their accountant about and realize when they do have a substantial change in taxable income from one year to the next, they really need to understand how this PAYG installment system works so they don't get caught out. Because a lot of people think, okay, I've saved the tax for 24, thinking that they've got another year to pay the tax for 25, and they don't realize the ATO is going to come knocking on their door for that money sooner rather than later. So, Rekha, a good question, really simple in your situation because you've got that investment income. And what I would say is that if you pay the installment, because if you grossly underestimate your income, the ATO can charge penalties. They don't often do, maybe not in this situation, but there's no incentive for you to underpay the tax. And the way I look at it is to say, I'm going to pay it anyway. So, why not pay a little bit now? And if I have to pay a little bit when I lodge my tax returns, that's not too bad. Okay, next question is from Warren. Warren writes, your podcast keeps getting better and better. Of all the many business and investing content that I listen to, I've come to value your explanations and opinions more and more as I think of your advice over and verify it with the real world. Very impressive. Thanks so much, Warren, and I'm glad you're enjoying it. Quick question. If someone and their spouse were to set up an industry super fund for long term, is it sensible to choose two different high performing funds, some diversification against scandals, disasters, or should they both invest in one, the best fund that they can identify? So great question, Warren. I reckon you diversify. And it's a good question. Actually, I was going to say I haven't really thought about it before, but actually that's untrue. We have some clients that will have One spouse will have their super with UniSuper, for instance, and then the other spouse will have their super in a wrap platform. And we're quite comfortable with that. Like, we haven't changed it. Now, that might be circumstantial. Like, when the clients come to us, if one is already in UniSuper, then I might decide, well, actually, it's kind of good to have some diversification. I don't know. There could be circumstances where we've actually proactively done that and said, look, one person put their super here and one person put their super over here. But I kind of like it. You kind of sort of balance it out. You go industry super fund, pick the best one and move it if you need to. If the returns obviously deteriorate, it's something that you want to periodically review, and then maybe use a wrap platform, something that gives you a little bit more sort of flexibility around tax planning, which I sort of spoke about at the previous question, and a little bit more transparency over investments. And then maybe at a sort of total portfolio level, the client level, you kind of balance these things out. So I like that. Also, you got to think about concentration risk. And if you do put all your eggs in one basket, if you get the choice perfectly correct and it remains perfectly correct for a long period of time, then you're okay, of course, but the probability of that occurring is pretty low. So I reckon 2 different industry funds, or, two different structures like industry fund and wrap platform, like we've done for some of our clients, I think it makes great sense, particularly as your balances start to become a greater proportion of your overall wealth. So sometimes I meet clients that have really low super balances and they're with the same industry fund. As long as it's a great industry fund like UniSuper, I'm not too worried. But if I've got clients where they've got substantial wealth inside super and that it's a substantial part of their retirement strategy, then yes, I think it does make sense to diversify that. Okay, let's squeeze in one final question from Nanny. It's quite a good one. Nanny writes, I've come across your podcast earlier this year. It's become a regular on my commutes to work. Great insights and really enjoy how you objectively try to simplify things backed by numbers and data. Your case studies are super inspiring as well. So thanks so much again, Nanny. Thanks to everyone that writes in and provide their feedback. Could you please help me with the following question on insurance within super? I had heart surgery around 10 years ago. I'm currently 34, white collar professional with income about 150,000. My super fund rejected my application to increase my life and TPD insurance. I would like to have a decent amount given life changes, mortgages and newborn twins. Oh, well, twins. I have twins. They actually just turned 18 earlier this year, so good luck with that, Nanny. That's an exciting journey. Anyway, what are the challenges with having insurance default life and TPD across multiple super funds, say 4 to 5, to get a decent sum insured with default options, apart from the obvious higher admin costs? Will there be challenges to beneficiaries during payouts? What is your recommendation in this scenario? So it's a great question, Nanny. And just for the people that may not really understand, what happens when you join an industry fund? Typically, they have default covers that are sort of based on your age, could be occupation, also income. And you can opt out of that default cover, but it's just a way of helping people get some insurance cover, particularly for people. A lot of people don't really think about it, and they just think it's in the member's best interest to have at least a little bit of cover. Going back 10 years ago, that default cover was not underwritten, and it was just given to every member. When I talk about underwritten insurance, that's quite important. So insurance that isn't underwritten means that it's assessed when you apply for a benefit, not when you actually apply for the insurance. Now, the problem with that, of course, is if you have pre-existing conditions like heart surgery 10 years ago, it's entirely possible, if the cover is not underwritten, that the insurer turns around and goes, no, pre-existing condition, I'm not going to pay out, because that was the term of the policy. I mean, if you look at the PDS, the product disclosure statement, it'll probably say that in there, that we will look for, pre-existing conditions, and we're not going to pay out if one exists. So when we go and get insurance, quite often clients will grumble about, I've got to do blood tests, they've asked these questions, they want to speak to my doctor, etc., etc. It is a pain in the neck, but it's a benefit because we make sure the insurance is fully underwritten at the time that we apply for it, which means that it gives the insurer a lot less wriggle room to get out of paying a benefit in the future, which is the whole point, right? You want to, if you're going to pay for something, you want to know that if it comes time to claim for that insurance, you're actually going to get the payout. Now, with default level insurance, It's going to depend and vary from industry fund to industry fund, but they have really clamped down on this. They used to not ask any questions and you get the default cover. And whilst it wasn't underwritten, that it's fine. In most circumstances, they're not even going to worry about pre-existing conditions. But they've had to manage, the cost of insurance and the rising premiums, just like everyone else has in the world. And now their approach has changed. So quite often, even with default cover, there'll be a brief medical questionnaire and it'll ask things like, have you had surgery? Have you had major surgery? Now, if you don't answer those questions honestly, of course, then when it comes to claim time, they're going to deny the claim. So it's not in your best interest to do that. Now, if you can find 4 to 5 different industry super funds that don't ask those questions on a medical questionnaire and just give you default cover without any underwriting and without any problems, will that work? Well, Nanny's obviously spoken about, well, it means you can have 4 or 5 super accounts and therefore more administration fees. But the admin fees are like $96 a year, $100 a year, sort of around about that. It's not that big. I mean, it's a bit of money, but not that big a deal if you're really keen on the insurance cover. The key thing here, though, is to make sure every fund knows you have insurance elsewhere. Okay, so sometimes these insurance products have what's called offset clauses, which says that if you're going to get a benefit from somewhere else and that benefit, then we're going to reduce our benefit by that amount. And if they all have that, then it means, only one's ever going to pay out. So you might get $100,000 of cover across 5 different funds. And if they all have offset clauses, you're never going to get 500,000. You're only going to get 100,000. So if you want to try to find a way to do that, you can try and use the default cover, Nanny, but make sure that you disclose that you do have pre-existing cover with other funds and make that really clear to them. And then also I would ask about the underwriting aspect and pre-existing conditions. Just make sure that default cover doesn't exclude those items because, again, you don't want to pay for something that you're never going to get. And the final thing, Nanny, is maybe speak to a specialised insurance advisor. They might be able to speak to some retail funds that can give you some cover. You can still own it inside super, but those retail funds like Astron, Zurich, these sorts of providers. Actually, I think Astron was sold, but because they might have more flexibility. Typically, if it was 10 years ago and you're not undergoing any more treatment and you haven't had symptoms for more than 5 years, typically the retail insurance providers would consider a scenario like that. So that could be an option. And often they're a little bit more flexible and they're fully underwritten compared to industry super fund. But it's a great question. And these insurance questions and knowledge is, I guess it's an opportunity to kind of share that insight as well, because a lot of people think, oh, I've got the cover, I'm paying for the cover, I'm okay. But understanding the exclusions, if it's underwritten, how it all works, does each provider know that there's other providers in the mix, other offset clauses, those sorts of things. It's really critical. Okay, longer episode today. As I said, I want to squeeze in more and more questions. I still have a bunch of them, about 30 pages worth, but I'm really getting through them. So again, just as a reminder, if you have any questions or feedback in regards to the podcast, love to hear from you. You can email questions@investopoly.com.au. Of course, that email is in the show notes. And until next week, bye for now.